Everyone was getting rich. Then everything broke. To understand why the crash shocked America, begin with what came before it. During the 1920s, factories expanded, consumer products spread, and newspapers celebrated a new age of prosperity. The stock market became a national obsession. From August 1921 to September 1929, the Dow Jones Industrial Average rose from 63 to 381. Roughly 6 times higher. The lesson seemed obvious. People who bought stocks became richer. People who waited were being left behind. Many investors were not buying only with savings. They bought on margin. A typical customer might pay roughly 10% of a stock's price and borrow the rest from a broker. Rising prices made this look brilliant. The investor controlled a valuable asset with very little cash, and gains were magnified. But leverage worked in both directions. When prices fell, the broker could demand more money immediately. If the customer could not pay, the stock was sold, adding still more selling to a falling market. The headline prosperity was real, but it was uneven. Agriculture had struggled for years. Some industries were slowing, while stock prices continued climbing faster than the businesses beneath them. Credit had helped inflate speculation. Policymakers worried, yet stopping the boom without harming the economy was difficult. In September 1929, the Dow reached its peak. Prices then began to slide. At first, many investors treated the decline as another chance to buy. They had seen the market recover before. Why should this time be different? On Thursday, October 24th, selling became panic. Huge orders hit the New York Stock Exchange. The paper ticker that reported transactions could not keep pace, so quotations arrived hours late. Investors across the country were making decisions without knowing current prices. Outside the exchange, a crowd gathered, searching for news. Inside, brokers struggled through the flood of orders. Rumor moved faster than verified information, and uncertainty became its own source of fear. That afternoon, leading bankers met at the offices of J.P. Morgan and Company. Richard Whitney, acting for the group, walked onto the exchange floor and publicly offered to buy major companies at prices above their current bids. It was theater with a purpose, show that powerful institutions still believed in the market. Confidence briefly returned, and the worst of Thursday's collapse was contained. Newspapers described a rescue, but the bankers had changed the mood, not the underlying pressure. Friday brought a fragile calm. Then came the weekend. Investors studied their losses, lenders reviewed accounts, and margin calls spread. Anyone who needed cash faced a terrible choice: provide money they might not have, or allow their holdings to be sold. The rescue on Thursday had encouraged hope that wealthy banks could always create a floor beneath prices. By Monday morning, that hope met a wall of sell orders. This was no longer one frightening session. Trust in the entire boom was beginning to break. On October 28th, Black Monday, the Dow fell nearly 13%. The bankers' display of confidence could not absorb the selling. Stocks that had represented security and progress were dumped simply because owners needed to escape before prices moved lower. Falling prices triggered margin calls. Margin calls triggered forced sales. Forced sales pushed prices down again. The system had created a feedback loop, and each attempt to flee made the exit narrower for everyone else. Tuesday, October 29th, became the defining image of the crash. The Dow lost almost another 12%. Enormous trading volume overwhelmed communications and paperwork. The Indianapolis Times called it the greatest stock crash in history. Paper fortunes vanished, but debts did not. The popular story says ruined financiers jumped from buildings in waves. Contemporary evidence does not support that legend. The real disaster was less theatrical and more widespread. Savings destroyed, credit damaged, and confidence erased. Black Tuesday was not the bottom. By mid-November, the Dow had lost almost half its value from the September peak. There were rallies, and each recovery tempted people to believe the nightmare had ended. But the long decline continued. By July 1932, the index stood 89% below its peak. It did not regain the pre-crash high until November 1954. For anyone forced to sell during the collapse, a recovery 25 years later offered no rescue at all. The crash did not single-handedly cause the Great Depression. America was already vulnerable, and later banking panics, business failures, policy mistakes, and international financial crises turned contraction into catastrophe. But the crash mattered. It damaged wealth and confidence, weakened consumer spending and investment, and made the financial system more fragile. The New York Federal Reserve acted quickly to supply liquidity in the immediate crisis. Yet the broader system failed to prevent later waves of bank failures. The aftermath changed the relationship between Wall Street and the public. Investigations led by Ferdinand Pecora exposed conflicts, manipulation, and abusive practices within finance. Congress passed new securities laws, and the Securities and Exchange Commission was created to enforce disclosure and market rules. Those reforms could not return lost savings or erase the depression. They reflected a harder lesson: markets depend on confidence. But confidence without transparency, limits, and accountability can become a machine for turning optimism into panic. 1929 is remembered as the day greed was punished. The real lesson is more complicated. The boom drew strength from genuine innovation, easy credit, social pressure, and the belief that recent success proved future safety. The crash accelerated because millions of private decisions were connected by debt and fear. No bell announced that optimism had become a bubble. By the time, everyone recognized the danger. Everyone wanted the same exit. And that is why the story still matters whenever someone says prices can only go up. If you enjoyed this investigation, please like and subscribe to Annie Stories for more evidence-led stories.